This last couple of years has been absolutely crazy for investors. Just listen to some of these statistics. In the UK, platforms like Hargreaves Lansdown saw 84,000 new accounts created in the second half of 2020. Freetrade saw 600,000 new investors pour in, and apparently everyone Googled how to buy shares. Across the pond, platforms like Robinhood got 20 million new active users, and then also we had some massive IPOs. Companies like Coinbase had some of the biggest IPOs of all time, and then also meme stocks became a real thing. You may not know it, but we're in the longest bull market we've ever seen since the end of the financial crisis around 2008-2009. That's over a decade of uninterrupted economic growth and prices in the stock market. Almost every stock you could have picked randomly or even just let a monkey do it could have made you money. And of course, it ends up making you feel like you're Warren Buffett all of a sudden. But wait, this is where things get really interesting, because as we know, investing isn't always just a straight line in one direction. Crashes happen all the time, corrections happen all the time, and bear markets happen a lot more often than we realise. Big swings and volatility in the market on any given day, week, month or year is just a normal part of investing, but our most recent experiences over the last decade hasn't really prepared us for potentially what might come in the future. So this got me worried, and it's also got me thinking. All of these new investors who've piled into the market, who've never really experienced what a bear market might look like, and I totally include myself in that bracket as well. Even after nearly 10 years worth, I've sold out plenty of times, made some horrible mistakes, and even during 2020, during the horrible pandemic, I was completely out the market for a long amount of time. The only thing I think we can really do is look back at the past and see what's happened before us, and of course we've got more data than ever before to go through to try and work out and see what mistakes have been happened before, how we might be able to correct those mistakes, and what we should do potentially moving forward. So in this video, I'm going to look at all the reasons why new investors especially are probably going to lose lots of money and make the same mistakes as happened in the past. And then I'm going to talk about all the things that you can do to potentially improve that and mitigate against all of those risks. So hopefully by the end, you'll be in a better place, and in 10 or 20 years time, a lot richer too. This first one might seem like an obvious one, but it keeps trapping people time and time again, trying to time the market. If there's one thing in life we know it's true, is you cannot predict the future, no matter how good you think you might be, and investing of course is no different. One of the main reasons investors lose money is trying to time the market. Trying to buy on the dip, trying to buy on the way down, and then of course selling when things they think are about to hit their near all-time highs. There's a famous quote from Peter Lynch, who's one of the most famous fund managers of all time with one of the best records of return in the market. And he says, "Far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves, and trying to time the market is no different. It doesn't matter if you're Warren Buffett or Jimmy Buffett, you can't tell what the market's going to do." No amount of fundamental or technical analysis is going to tell you what the exact price of the market is going to be a week from now, a month from now, a year from now, or whatever time in the future. And funny enough, if there was a strategy that could be proven 100%, everyone would do it, and that strategy would in fact end up dying because everyone would try and preempt it. So stop trying to time the market. This one's an interesting one, and of course I think we're all guilty of this one, especially when we get too excited in the market, tinkering too much and doing too much trading when really we should be doing nothing. In a study published looking at trading data between 1991 and 1996, Barbara and Odin looked at the behaviour of 66,000 households, and the results are really interesting on their returns. The average household return was 16.4% in gains, while the market returned 17.9%, but those with the lowest returns were the ones who traded the most and made only 11.4%. So while the market was flying high and just buying the market and holding it would have been the best strategy, in that respect, those who tried to tinker, those who tried to buy low, sell high, unfortunately, didn't come true. And the best strategy in that example would have just been to do nothing. Now, of course, while trading is completely different than it was maybe in the 90s and the 2000s and is cheaper and easier than ever, there's still cost to bear. And whether that's the cost of the spread, the cost of your time, or the opportunity cost of missing out, it's best not to tinker too much. And of course, once you've made your trades and decided on your strategy, is to stick with it over the long term. If you're not investing for the long term and you're consistently making trades often, then the likelihood really is you're not falling into the category of a long-term investor and you're really just a trader. And while I wish you very good luck, it's not a good way and it's not a proven way of making good returns in the long run. In number 3, and it's still something that catches me out all the time, is trading with too much emotion. Our emotions and how we feel about our investments is one of the biggest driving factors in the stock market. Whether it's tulip mania back in the 17th century, where the prices of tulips went absolutely out of control, or whether it's even back more recent times during the dot-com era when everyone lost their minds when a company had .com at the end of their name and put unlimited money into these kinds of investments. There's so many lessons we can learn from these periods of over-exuberance and speculation that really reminds us to not get too excited and not get too attached to our investments. As people panic and buy things on the way up, there's going to be plenty of losers, and sure, there'll be a couple of winners along the way, but lots of people will lose money and buy things at the wrong time and then sell them on the way down as well. What a waste of time. These things have happened before and they'll probably happen again, so just watch out. And my final point and my final trap for investors, especially new investors, is although they say they're long term, is having that short term mentality and only really being focused on the weeks and months ahead. I'm definitely concerned that lots of new investors, and I include myself fully in this, that we've been so used to seeing some crazy double-digit gains even in weeks and months, whereas the market in its old boring form would never have delivered these kinds of gains. And we've got way too used to seeing things only going in one direction and going up that I'm genuinely fearful of what we will do when markets may be correct, or we do have a small market correction or some kind of crash. A 20%, a 30% for example, what would we do and what will new investors do who've only seen the market go up? We know from the past that the market crashes and corrects all of the time, but of course we haven't seen one in recent times, and look, we may never see one for a long time yet. I certainly don't want to scaremonger, but the worst case scenario here could be you completely sell out of the market, you absolutely lose your mind, you get scared of investing, never do it again, and then you end up keeping it all in cash or putting it in some other investments, so you end up losing entirely. A lose-lose situation. Now, onto the more positive side of the video, but the good thing about all of the points I just raised earlier is that all of them can be solved with following some simple steps, so pay attention. Lucky for you, we've got over a century's worth of data that we can go back and test all of our theories on the stock market and test all of the different ways we might want to beat the market, or at least get the returns of the market to our best of our ability. To a lot of you, these points will seem self-explanatory and very simple. To others, these will be completely mind-blowing. But either way, some of these points are from some of the best minds in the world and some of the best investors. So let's jump straight into them now. Firstly, and this one might seem obvious, but not investing at all is probably one of the worst ways to guarantee your failure. This comes back to a video I did just a few days ago talking about the dangers of inflation. And we've just heard this week from our Chancellor saying that we reckon inflation will be around the 4% mark. So this means that any cash in a terrible bank account earning no interest at all, or just kept as cash maybe under the mattress, is going to lose you 4% every single year guaranteed. So in order to invest, we need to find investments which are going to grow larger than 4% just to stay afloat. This is absolutely key. So make sure whatever you do, you're invested somehow. For my second point, we can clearly see through history where those returns have come from. And by far the biggest winner is stocks in the equities market. Rather than looking at anything like bonds or any kind of fixed income products, the best returns have come from equities. And while there's been lots of ups and downs in each year, over the long period of time, equities have risen and have provided value to shareholders, and this is really where a bulk of your assets should probably be. Look at this chart outlining the best performing assets over the last 10 years provided by BlackRock. These guys are one of the largest wealth managers in the world. US equities lead the way here by a massive way, and then of course REITs come in a close second, but nothing else really compares. So take this data, make what you want of it, but realize that the biggest returns have come from holding stocks rather than anything else. In number 3, and something you'll see in almost any single book on investing and personal finance, is that low cost index fund investing is one of the surest ways that your money will grow and you'll beat 90% of active funds over the long run. In my opinion, and of course depending on where you are in your financial journey, low cost index fund investing should be the absolute core of your investing portfolio, and regardless of what else you build around it in a kind of core satellite approach, that core part of your investment should be a low cost index fund, either covering the world or at least a large part of the stock market. As much as you or I might enjoy looking at different companies, and of course I'm no different to myself, I do hold some different separate companies. I do hold cryptocurrency as a hedging against inflation and also as a speculative bet. The core of my portfolio will always be low cost index funds. So regardless of how confident you are or how sure you are of a certain bet, whether you just YOLO'd everything into Tesla, do remember that proven back on history, we know that index fund investing works and we'll get our share of the rewards of the market without having fees eat into too much of our investments. And to prove this point, one of the greatest investors of all time, Warren Buffett, even made a bet with a group of hedge funds for $1 million that said an index fund of the S&P 500 would beat all of their managed funds. And of course, guess what happened in the end? Well, to no surprise, that index of the S&P 500, completely low-cost index fund, ended up beating all of their hedge funds, and in fact, beat most of the hedge funds by a really long way. And luckily, all that money was donated to charity. But if one of the best investors of all time is telling you to do that, then I would take some advice from that person, and I would definitely pay attention and listen. In 4, time in the market. Again, this comes back to our long-term investing plan, that once we invest for 5 years, 10 years, 20 years, we massively increase our chances of making sure that even during terrible times in the market, that we actually increase our wealth. There's plenty of information and data out there that shows as long as we are investing for that period of time, 5, 10, 20 years, and especially 10 or 20 years, that even during the worst economic times, we will be guaranteed to win some kind of investment and guaranteed to get some kind of growth. There are no periods of time across the span of 20 years where you would have lost money in the stock market. And although your gains may not have been amazing, you would never have lost money. So time in the market is absolutely critical here. So as long as you can be a long-term investor and you're not a day trader or some kind of speculative trader, investing for that long run is super important. Next up, to counter timing the market, dollar cost averaging is a great strategy. That's where, of course, you put in your funds, put in your money every single month, maybe as you get paid. And although in lump sum investing technically wins the majority of the time, in this scenario, dollar cost averaging when you get paid is technically doing lump sum investment, because that's all the money that you have. And doing that consistently on a consistent basis over a long period of time beats people trying to time the market, detaches your emotions away, and is a fantastic strategy that's been proven over decades and decades. And finally, and this really ties back to some of my biggest regrets, and probably lots of regrets for most investors, is that start early. The earlier you start investing and the sooner you get your money invested, the longer you've got for compound interest to grow, and of course the longer you've got to weigh out all the different economic downturns in the economy. And also, it's never been as easy as it has to get invested, even for a lowest cost possible. We have all these amazing low-cost index funds out there, some wonderful platforms to choose from. Some of the links in the description below. Platforms like Free Trade, of course, Trading 212, Hargreaves Lansdown, AJ Bell, Interactive Investor, you name it. Low-cost ways to get your money into the stock market that you would have never had access to many years ago. So make sure you start early. Please seek financial help if you need it. Remember, I'm not a professional qualified financial advisor, so please do all of your own research, but if you can start early, you'll be in a good place. Anyway, with all of that said, none of us know really what can happen in the future. Anything can happen a week from now, anything can happen a month from now. We can't control the future, but one thing we can control, and probably the only thing we can control, is how we react to those events as they happen. What goes on between our two ears and everything what goes on up here is probably the most important thing when we look at stock markets. Not falling in love with our investments, making sure we stay consistent, making sure that we invest over that true long term is a guaranteed way that we can at least prove using hundreds of years worth of data that we should do well in the future. Markets will continue to go up, I've got no doubt about that, and in most years markets will go up more than they will go down. And the longer we do that time horizon, then the better our prospects will be. Stick to your plan, find what works for you, make sure the plan you stick to is the one which is going to be right for your financial situation, making sure that you can sleep well at night, whether you want to be more hands-on or hands-off, find what works for you, but either way, stick to it for a long term and you should do very well. Anyway, if you made it this far, I really appreciate you watching. Drop me a big fat like, subscribe for many more. Thank you to the nearly 500 people who joined me so far on this journey. I'll see you guys in the next video, and as always, happy investing.